Okay, I'm going to focus a little bit on when Biden took office, what were the views regarding him, and then come back to reality on how he has actually performed and achieved in this 100 days. As you can see in this poll here, this is taken from The Economist. Essentially, when he first took office, obviously there were a lot of things on his plate. But you can see that the top two items on his agenda that Americans really wanted him to take care of really was healthcare because of the COVID pandemic. And secondly, it was all about jobs and the economy. Climate change came in a close third, and then followed, you can see that actually at the bottom of the list really was national security and foreign policy. So in fact, if you look at the Biden-Harris administration immediate priorities, they didn't actually list foreign relations or China. So I think the sense really is that his priority really was to get his domestic house in order first before he can actually focus on external issues. So if you look at where he's standing in terms of the approval ratings right now, the latest one taken by the NBC News actually suggests that 53% of the Americans polled approve of what he has done so far. So if you want to take this as a relative comparison, you can see that it compares quite favorably compared to Donald Trump in his first 100 days, but he is still lagging a little bit behind Obama, in the first 3 months or so of his term. And where he is getting the thumbs up really is in terms of the handling of the COVID and also in terms of the economy, because he has been pushing out the fiscal stimulus fast and furious. And he talks a lot about the country, but actually 80% of those polled think that the country is still very divided. And then if you look where the approval rates are very, very low in terms of issues, one would be China, the other would be about border security and immigration. So it does look like it's still a very disparate type of approval rating for Biden. Let us take a quick look at the first priority, which is really on how he's handling the pandemic. Actually, if you look in terms of his initial targets, 100 million in the first 100 days, then it was raised to 200 million. It's already met the target. In fact, at the last count, if you look at the speech that he just gave earlier this morning to the joint congressional session, he said that basically 315 million Americans have already been vaccinated. So he is coming in way ahead of his target. That said, I think the road going ahead may be a little bit tougher, because if you look in terms of the poll, the amount of vaccine skepticism of those who still haven't been vaccinated, currently those that want to take the vaccine now has dropped below 40%. So that's something to take note of as we go ahead. In terms of how active he has been, if you compare Biden with Trump and Obama and even George Bush, you can see that actually he's been signing a lot of presidential executive orders. In fact, he just signed another one overnight. But in terms of the confirmed nominees that he has managed to actually achieve, is still lagging a little bit behind, Clinton and Obama. And I think this is testament to the fact that actually, although he has control of both the Senate and he has control of both houses, nevertheless, actually, his support level is not that strong. So he can appoint a lot of White House appointments, but in order to get the confirmed nominees through, is still lagging a little bit behind. So what are some of the flurry of the executive orders that he has signed? You can see that 22 of them actually are direct reversals of earlier Trump policies. So he's put a little bit of sanity back to some of the Trump initiatives. And I think some of it is actually quite welcome by the international community at large. So some of that includes rejoining the Paris Climate Accord, doing the right thing, which is to require mask wearing. Although now I think the latest is that actually for the vaccinated people, they are actually relaxing some of the mask wearing rules. And I think what will be of concern really is how is he viewing China and also ASEAN in the coming days when he tightens up a little bit more on his foreign policy outlook. I mentioned this earlier, that he basically has a fairly slim majority control. The Senate now is tied 50-50. Basically, they have a one single vote majority with VP Harris as the de facto president of the Senate. But, if you look at the Republicans, they do still have significant influence. And in fact, if you look at some of the Republican response to his latest, fiscal stimulus plan, it suggests that he's not going to have a very easy time trying to pass further stimulus from here as well. In terms of COVID, one point to note really is that the Defense Production Act that was actually first, used by Trump and then increasingly by Biden as well, in order to ramp up the production and the vaccination program in the US, has come at a little bit of a cost to the rest of the world. So there was actually this American export controls on the raw materials and equipment that was going into the global vaccine production. And with a lot of the spotlight on the deteriorating situation in India, America had to basically give a special concession to allow the export of some of these materials in order to prioritize the vaccine going to India itself. So I think one thing we still have to watch out for is that in the global economy today, access and accessibility to vaccines remains an issue, and you may still have this divide between the developed markets and the developing markets. So I've said quite a fair bit about the stimulus. The second big issue, if you remember, that was on top of the Biden agenda really was the economy after COVID. So he's managed to pass his 1.9 trillion COVID relief bill, okay? So that $1,400 paychecks actually went out to a lot of the eligible individuals. And that has benefited to a large extent some of the consumption numbers that we are seeing in recent days. In terms of the labor market, you can see that there has been a sharp improvement since the end of last year, and the unemployment rate has come down quite a fair bit. Going forward, he has another 2.25 trillion infrastructure plan as part of his Americans jobs plan and his Build Back Better program. A lot of it is on infrastructure. So if you're thinking in terms of where are some of the opportunities in the US economy, clean renewable energy is one, upgrading of roads and bridges will be the other. Okay. He also has been a very keen advocate of green renewable energy. So one of the key thrusts really is in terms of the electric vehicle market. With a proposed 174 billion investments, I think there will be some interest in terms of the manufacturing of higher value goods such as EV components as well. The other angle of this really would be on the solar and energy storage side as well. So some of the industries that are tied to this will also be benefiting from the upcoming plan if he manages to get it passed. The headwinds, on the other hand, will be for your traditional fossil fuels sector like the oil and gas, right? So there'll be a sizable demand shift away. And I think on top of that, some of the drilling restrictions will probably hamper the oil industry going forward. So in terms of the foreign policy reset, I think what's quite clear is that none of us have to stay up until 3 a.m. anymore to see what's coming through on the tweets, right? So it's a little bit more sane now. I think in terms of the US returning to the global stage, we did see a shift away from the America First mindset. So like I mentioned earlier, they have rejoined the Paris Agreement. They are not withdrawing from the World Health Organization. They will support NATO. And I think in terms of re-engagement of the allies and negotiations with Iran is quite clear. But what has been quite characteristic of the Biden administration as well is that actually has been more vocal in terms of human rights abuses. So what's quite interesting is that actually the rhetoric sounds very different in some areas, but the policies actually look remarkably familiar. So he did reiterate again in his speech this morning that he's going to be tough and he'll protect all the interests of the US against China and Russia. So I would sum up his approach as one where he's an advocate of fair competition, but he's also willing to talk and to look for potential cooperation and collaboration in areas like climate change and COVID-19. So for China, it's quite clear. It's still it still boils down to one of strategic competition. And then if you look in terms of the first White House foreign visitor he had, which was the Japanese PM Suga, the statement was quite interesting because they actually did mention about stability in the Taiwan Straits. So again, sounds like it's fairly targeted at China. It's not all bad. I mean, if you look at some of the positives with the Biden administration, one initiative, for instance, is the IMF Sgr Allocation. So they have given their support to a potential 650 billion worth of SDR allocation. And this means that actually for a lot of the regional economies, they will get a boost to their reserves. So even though they don't really directly need the money at this stage, but it acts as a very convenient backstop or insurance just in case. The other positive really is that having appointed a very steady hand, which is Janet Yellen at the head of the US Treasury, you can see the difference this time around. The latest semi-annual report on currency manipulators. So they didn't actually label any country as a currency manipulator, even though Taiwan, Switzerland, and Vietnam actually met the 3 criteria. And if you remember some history during the Trump administration, actually Trump tweaked the 3 criteria in order to catch more countries into the net, right? So 11 countries for now under this criteria still remains on the watch list, but nevertheless, I think they are really more open to bilateral negotiations on how to adjust some of this trade or current account surplus and the FX intervention side. So I think it's a fairly benign start to Yellen and the Biden administration, at least on the FX front. Well, the not so good news is that, people always thought that Biden will come and reverse some of the tariffs that they have levied against China, and that they will reverse some of the antagonism that seemed to, shadow the bilateral trade. But actually, there has not been any unwinding of the tariffs, right? And in fact, if you look at the appointment of the US Trade Representative, Catherine Tai, the sense is that the tariffs will still be a very useful leverage in terms of any upcoming trade talks. So you remember the recent talks that they had in Alaska, a lot of show and tell, but not much actually got done. And then if you look in terms of the sanctions, actually, I think it could potentially be even tougher than Trump, right? Because you have basically, you use bans against companies, especially on the telco front, you have sanctions on key officials. And a lot of this got to do with, Huawei and also some of the Xinjiang issue in Hong Kong. So I think this is going to be still a fairly uneasy relationship in the coming months. Let me take one step back and look a little bit at where we stand today for Asia and in particular ASEAN, right? So this is a very interesting Conference Board Consumer Confidence Survey. It does suggest that confidence has picked up quite dramatically in the last 3 months or so. And in fact, you can see that Asia Pacific region is leading the way in terms of the improvement. So if you look in terms of the first quarter GDP numbers, not all has actually announced, but China, Singapore, for instance, have announced, and the flash numbers actually look quite optimistic. China really was the other exception, really, in the sense that although it shows a huge bump of 18.3% year on year, because they were the first in and first out of the COVID crisis, nevertheless, this was actually slightly below market expectations. In terms of how the Asian countries are handling COVID, for instance, this Bloomberg survey actually shows that Singapore overtook New Zealand to rank first, but you can see that Taiwan, South Korea, Japan, Hong Kong, Vietnam, China are all doing relatively well as well. So in terms of the last few years under the US-China trade war under the Trump administration, it's quite interesting to see that actually despite the levying of higher tariffs, the trade numbers haven't taken that big of a hit, right? But what is really noticeable is that actually China's direct investments in the US has slowed down quite dramatically since 2017. So you may think that it's a trade war, but actually where the numbers are really showing up in terms of the impact is really more an investment war. And if you look in terms of the sectoral breakdown of where the sectors are seeing the investments fall off, and it could really be in areas such as wholesale and retail and leasing. But manufacturing and ICT is still fairly resilient for now. So there has been a study by the IMF showing that if you really force a US-China technological decoupling, then that could be net about a 5% loss for global GDP. And what about for trade and the others? So I won't dive into all the details here, but I think generally the sense is that, both sides will have a lot to lose, including the US. So if we turn our attention to what's happening in Hong Kong, a lot of people feel that Hong Kong is kind of like a proxy battleground, right? because of the enactment of the national security law and some of the other tit-for-tat kind of sanctions. If you look at the actual effect on some of the Hong Kong markets, so we look in terms of like people moving their accounts offshore, the actual people migrating, or people withdrawing their pension funds, or in terms of taking up the new visas in UK, actually it's been a fairly mixed bag. And what's quite interesting is that actually Hong Kong, you may think that things would be actually quite affected by what's happening on the political front. But actually the financial markets are booming there. And they are still benefiting a lot from the trade and logistics because of the China Plus One strategy, and also because of China's dual circulation strategy. So the IPO pipeline is very strong, and there's still a lot of corporate interest in the Greater Bay Area. And then if you look in terms of, okay, let's move our attention away from Hong Kong to Southeast Asia, right? So it's not all bad for the regional economies, even though we still have this US-China tariffs still hanging overhead us, right? In fact, Facebook and Google have announced the construction of a submarine high-speed cable that will connect Indonesia and Singapore via Guam rather than Hong Kong. And this will be the largest capacity high-speed transmission cable across the Pacific Ocean, right? So it's good for basically land-based internet access, and it will help to improve a lot of the internet connectivity. So ASEAN itself is also not sitting still. I mean, even as they recognize that US and China relations will still be fairly choppy going forward, the RCEP, for instance, that has positioned China as a more medium-term economic partner to ASEAN compared to the US. But I think they are really open and hoping to continue to be an advocate for free trade and regional integration. And then if you look in terms of the diversification of supply chains that have come across as something that's very urgent because of the COVID pandemic, when global supply chains were disrupted and people were scrambling for essential supplies of goods and services. And also more recently, if you look at what had happened with the Suez Canal, you realize that actually it's better to be more diversified in terms of your sourcing, especially for critical components and even for capital-intensive industries. So major nodes in the Asia electronic supply chain are still quite intact. So although there is a lot of talk about reorganization away from China, this will benefit Vietnam, Taiwan, and Malaysia, for instance. But China itself is also changing by shifting production away from final goods to intermediate product as a defense mechanism. So for Singapore, what is Singapore's role amidst all these different changes and megatrends? Singapore primarily acts as a distribution center for the exports of electronic goods. So you can see that from the current ongoing global chip shortage, actually the manufacturing and electronic sector have done very well over the last couple of months, right? But I think what's interesting is that the new projects that are coming into Singapore, especially on the FDI front, suggest that electronics will remain a key cornerstone of the manufacturing sector. And in fact, Singapore wants to ramp up the manufacturing share of the Singapore economy. So I think notwithstanding some of the rocky and choppy turns and twists in the US-China bilateral relationship, ASEAN and Singapore remains in a fairly good position post-COVID to actually leverage on the global growth recovery, and also in terms of the more advanced manufacturing evolution that we see in the supply chain within the region itself. So what does this mean if we have to continue to tread very carefully between US and China? We think that actually it's not that bad because the Biden administration, we think, is likely to adopt a more open approach to global trade. So in fact, if you look at US President Biden's Leaders Summit on Climate, he did invite Singapore PM to participate as well. And then in terms of the engagement with China, we also see that China hosted a lot of foreign ministers from ASEAN, including Singapore. So the relationship building continues to be one that is relatively strong. And in fact, you can see that ASEAN today has overtaken the EU as a top trading partner for China. So let me conclude with 5 key takeaways. One is that the Biden administration is off to a busy start, and they are trying to rebuild bridges and to re-engage with a lot of the multilateral and international institutions. The second point really is that maybe after the 100 days, Biden's honeymoon period may be ending. So the early indications are US-China strategic rivalry will continue, although there is some scope for greater cooperation in areas like climate change. Third point is that on the demand side, geopolitics we think will remain a headwind. If it is politicized, there are potential spillovers into the economic and commercial space. And in addition, we see the use of economic sanctions as increasingly a policy tool for human rights advocacy. On the supply side, we also have to be quite cognizant about some of the supply disruptions arising from COVID and so the Suez Canal blockage. So I think for a lot of multinational companies, they recognize that there is a need to diversify. And in terms of the onshoring or nearshoring, probably is a good strategy, especially if you need to build a buffer for some of the essential goods. In conclusion, ASEAN, I think, will still have to navigate this very choppy waters, even as it's perceived as a key beneficiary of the China +1 strategy. I think what's also quite notable is that actually the distribution of some of these economic benefits may not be even. So net, there's good and there's bad, and we just have to carry on. Thank you very much. Let me hand you back to Tiff.
Okay, and thank you, Selena. Thank you for the wonderful presentation. Now, next up, we have with us Mr. David Wijeratne, Growth Markets Practice Leader at PwC Singapore. He'll be talking about what are some of the implications for businesses, where are the challenges and potential opportunities arising, especially in Asia, and how companies need to act differently to execute growth strategies. David, please.
Thank you, Tiff. Good afternoon, everybody. It's a pleasure to be here, and thank you very much for the opportunity. So, just really building on the previous 25 minutes, about how Biden's first 100 days is affecting the region, and some of the key things that people operating in the region, both multinationals and local regional players, should be thinking about, probably from a bit more of a tactical perspective. I think, as we heard, this region has been facing a number of disruptions, both fundamental as well as events. Fundamental shifts around growth in consumer, in consumption, growth in maturing suppliers, but of course, environmental challenges, social inequalities, infrastructure, institutional challenges, all then compounded by events such as trade wars, such as the recent pandemic. All added together really makes companies sit back and think, do they have the right strategies in place to grow? Whilst Asia Pacific has, and particularly ASEAN, has proven to be a lucrative growth area or region historically, do they have, and will previous strategies be fit for the future? And so last year, from about August onwards, we as a firm began to look at this and try to identify some of the key themes and key growth pillars that companies, as I said, both multinational and those from the region, should begin to think about to ensure that they are fit for the future of Asia Pacific. And these 5 pillars, which I'll go through in the next 20 minutes or so, are here. So we start, but in no particular order, although you will see as I go through them, they are interconnected. So first one is around the digital economy, both looking at the role of digital solutions, but also the other side of the coin is the risk. The risks as we deploy more digital solutions, we are opening ourselves up to more cyber attacks and more security issues. Secondly, is really from an enterprise growth perspective, looking beyond developed markets from a growth perspective, where people might have historically thought of moving to Europe or the US for growth, looking more regional, but also within that, the role of services, growing across the region as a growth engine. You can't get away from supply chains. I think supply chains for any player has been something that has had to be reviewed, or the review has had to be accelerated if people were already beginning to look at that. And moving slightly or rebalancing from global supply chains to more regional supply chains. And therefore, what does that mean for Asia Pacific? How does that mean for companies that are already sourcing here, but We're manufacturing here, but now can source more, but also begin to sell more. So from a regional plan, and what's the role of innovation in that new regional supply chain? We can't get away also from people. This, I think, over the last 12, 18 months, I think how we future-proof our labor force, our talent, has been a critical question, both for employers today and for governments as they look at preparing for the employees of tomorrow in the sectors of tomorrow. And then, as we discussed earlier, the role of climate change, both in this region, we looked at a couple of aspects here. One was the role of the circular economy and how it really should be playing more of a role across some of the countries in ASEAN compared to what it is doing currently for GDP. And of course, the importance of adopting more technology, more smart measures within agriculture to enable to ensure that the region is more self-sufficient. So if I just go into the first point around the digital economy, I'm sure over the last 12 to 18 months, we've all seen, whether on a personal perspective or at work, increased usage of digital solutions. We're old habits are perhaps being accelerated as we move away from them, and we have to ensure, a number of businesses are looking to ensure that we don't drop back into that. However, we do need to make sure that we make these adjustments with the right balance. So from the companies that we were speaking to over the last 6 months of last year, we learned something which was quite interesting, is that whilst many people would be embracing that, understand the move towards digitalization, a number of the companies that we spoke to highlighted the fact that digital solutions might not be the solution for every issue or every pain point in a company's value chain, in a company's operating model. First and foremost, we need to identify where in the value chain there is a challenge, and that might be enhanced by process. It might be enhanced by a digital solution, but whatever the balance between those two, one common goal is better transparency and increased visibility throughout the value chain. If you look back at the last 12 months, you can see, particularly during lockdowns, the companies that were able to communicate, not necessarily deliver, but communicate with customers, whether they're enterprise customers or consumers like you and I, were those that still retained loyalty. They were able to see where the goods were, where they were held up, but they were able to communicate with the end customer. And that's because they had visibility. So enhanced visibility not necessarily improves delivery, but it does retain loyalty and improve customer experience. But that could be perhaps enhanced through digital solutions as well as process optimization. But as I said, the flip side, as I'm sure you're hearing on a daily basis, is the threat that as we adopt more digital solutions, is the threat of cyber attacks coming into our organizations, coming to our homes, and disrupting our businesses and lives. One mantra which I believe that we as a firm discuss with our clients is, it's going to happen. I'm sure all of us have received a hack at some point. Perhaps our email's been corrupted, it's been hacked or something. As a consumer and as a business perspective, I'm sure we're seeing attacks, at some point in our value chains on almost daily, if not a weekly basis. It's going to happen. So we have to assume a point of assumed breach. And with that mentality of assumed breach, we need to first of all identify what matters most. It tends to be critical data and identities, because those that want to hack into our systems and our personal lives want to assume our identity and pretend to be us and go and do nefarious things, or go and do things that we wouldn't necessarily want to do, use our money in different ways, use disrupt our business and therefore how we reply and interact with our customers. So we need to identify what's important, and therefore ensure that we put in the right safety measures, the right critical digital and cyber security measures to not only protect that, but also to detect when a threat is coming. And most importantly, to be able to respond speedily to ensure that when that breach happens, that inevitable breach, its impact is as little as possible. That we're able to respond quickly because we've identified what's important to us, protected it, or to identify it quickly, we can limit its impact. But first and foremost, we have to assume it's going to happen. And if we assume it's going to happen, we need to take action. Moving through that, beyond is how we look at how in this current region, in ASEAN and beyond, is the role of enterprise growth. And what I mentioned before is that companies now are within ASEAN and broader Asia Pacific are now realizing that growth as they break out of the domestic markets might not necessarily be in some of the developed markets that they traditionally entered, such as the US and Europe, but perhaps it's closer to home. Perhaps it is in China or it's in the broader Asia Pacific region, taking advantage of increased consumer consumption and rise in disposable spends. However, that means that companies do have to strengthen their capabilities to address that, and specifically around three specific areas. First of all, how they go to market, how they develop their distribution, their marketing and their pricing and their sales channels to be applicable and agile and relevant to the diverse, heterogeneous nature of Asia Pacific. They need to focus on ensuring that the operating model they have within the region, as they go from being a domestic company to being more of a regional company, has efficiencies in it. Quite often, as we see companies expanding, they expand and grow, but not always in the most efficient and profitable way. They actually add fat to their businesses through mergers, which could actually have been done in a more efficient manner. And finally, but core, is innovating on a very flexible and agile manner, to put these through together, to innovate products and services that are relevant to markets in an efficient manner, that are delivered whilst providing enhanced visibility, coming back to my point earlier around digital solutions, to customers, both enterprise and consumer. Now, within this, services has a tremendous opportunity for growth. I think services sector within Asia Pacific lags behind the global ratio of overall trade. And therefore, we can just see the opportunity, whether that's from more obvious things, whether it's e-commerce, but actually moving into other services, whether that's more into professional services, construction, travel, financial services. There is tremendous opportunity for growth across the region for these companies in these sectors to grow at an exponential rate. And we can expect to see that, and I'm sure you're seeing many of these in the companies that you're either working with or have visibility of in your sectors and countries that you're working in. Linked to almost all of this are our supply chains or value chains. I think even pre-pandemic, trade wars, we were seeing companies beginning to reorientate, rebalance their supply chains based on some of the fundamental shifts in global trade, shifts in consumption, moving more towards Asia Pacific, shifts in maturing suppliers. So actually, instead of supplies coming into the region and being manufactured and then sold out of the region, actually more being actually sourced regionally, manufactured regionally, and actually sold regionally, taking advantage and addressing the higher consumption opportunities and rising disposable spend. What does that mean though? So for two different players, those are the multinationals that had those global supply chains. They need to think about how they identify suppliers, how they identify control tower locations to manage more complex supply chains. Whilst the global supply chains were extraordinarily efficient, I think you only have to go back a few months to see how incredibly brittle they actually are or were. Regional supply chains, more complex, more players, and therefore they need to be managed using such capabilities as a digital control tower or digital hub, potentially housed here in Singapore. On the flip side though, this does provide tremendous opportunity for local players who were locked out of global supply chains as companies were not sourcing from the region, but perhaps were sourcing as the region, but now as multinationals to source more in the region. Companies who are from the region have an opportunity to start playing within those value chains, but it's not an automatic qualification. They have to qualify, they have to ensure that their capabilities, they meet the standards, they fit within the value chains that will deliver the quality that the multinationals or international companies are looking to work with. In that regard, there is room for capability enhancement to qualify. And in fact, we've just released a piece on this, and I will share that through Tiffany later, as to what companies really need to do to qualify, make sure that they can take part in these more regional supply chains. Innovation is a key element to this, as I mentioned before. Innovation from a corporate perspective in addressing opportunities more regionally, but innovation in the perspective of how things can be developed, not only new propositions, but also how these propositions can be brought to market. And we see different institutions, different players playing significant roles. Businesses, such as many of you on the calls here, taking a driving role, but playing with academic institutions to understand, to not only train and skill future talent, but also to innovate in certain sectors across ASEAN to ensure that we have a portfolio of innovation rather than a competing region. Government and government agencies have an important role in enabling, attracting investment, ensuring that smoothing the wheels for innovation to ensure that companies can come, innovate, work effectively with local institutions, and ensure these innovations can get to market in an efficient manner. As society, we as society have a role in being constructive in our feedback, in our criticism, in what we are looking for, to ensure that businesses and government institutions can react to what we're looking for as both corporates and consumers at the end of the value chain. The fourth pillar that we looked really, and probably is not surprising to any of you, is around our workforce. And in particular, how both corporates and governments should look to today and tomorrow in securing and future-proofing the future labour force. Quite often, I'm sure you hear the question as to what are the key skills that employees need to have for today. I actually think that's not the first question. And from what we've seen and what we discussed with our clients and those in the market, it's actually as to what is the strategic intent of the company, what is the direction that the sector is moving, and how are the roles therefore going to evolve to address the market, and therefore what are the skills that need to be developed and shared with our employees to deliver on those roles. I think too many times we have clients who come to us who looking to address a skills portfolio, but on an existing set of job titles and roles. But actually looking at the roles and where the sector and the market is moving, first of all, is probably a good place to look at instead of first asking what skills do we need to address. Supporting that then, that skills agenda, that training and development agenda, to really down to an individual, because it's going, how do you skill and maintain the relevance of those individuals in your organizations through the remainder of their career? And it's not a one shot, it's not a one training exercise. I'm sure we're all beginning more and more aware of this, that this is going to be a constant element of how we work. Constantly evolving, adapting to market demands, and evolving our skills to how our roles evolve, so that when we look back on our career, the role that we have towards the end is very different to the role that we might have had 3 years ago, 5 years, let alone when we started with the organization. Government, of course, has a pivotal role here, but in particular for the future, identifying the future priorities of growth for a nation. I think here in Singapore, we can see the government is doing all it can to identify its future vision and what sectors will play and sustain its economy. And therefore, having identified that, how do you identify the roles and skills needed for the future, and therefore work with the other institutions, the education institutions, society and business, to ensure that we have the right skills coming through to support the sectors of the future, because the sectors of the future might not be exactly the same as the sectors that have developed the region over the last 30 years. I'm sure we just have to look at a number of, you look at e-commerce, you look at financial services and how they're changing dramatically compared to the last 10, let alone 20, 30 years ago. So how those sectors are evolving, it's critical to understand what are the skills, how education systems, businesses have to evolve to support the roles for the future. And then finally, coming back to what is pretty much on the agenda of every company now around the ESG agenda. And I must say, whilst it's on the agenda of many companies, where we see, from the clients that we're talking to, many clients are still grappling as to how to address this. They may be committed, they may desire to want to make changes and improve how they run their businesses across the ESG agenda, but how many of them are getting stuck on E, the climate side, compared to the social and the governance? I think that's important. So we must not just ignore and focus purely on the climate agenda. Whilst it is critical, we need to also consider the S and the G. But if we go and look a bit more into it, if I return to what we looked at last year, specifically we looked at the importance around two areas of the circular economy, excuse me, and agriculture. And if we look at the circular economy perspective, what we were seeing is that we've seen various instances where government and corporates have come together with society to do some incredible things. If I give you an example of in India, where you have a company that came into just outside of Delhi to work with the local community to gather waste and rubbish, take that into a green incinerator, and that then fed into the local grid. It provided jobs, it provided green energy, and it provided an ecosystem that benefited the community. Sadly, that doesn't happen as much as it should. All the opportunity is there across the region, across ASEAN and YJ Pacific, for roles and initiatives like that to take further root. But at present, that is not happening. So businesses like yourselves, who are on the call here, can be thinking, well, how can we actually play a greater role here, which actually is profitable? It is not a goodwill gesture. It's actually something turning this into a commercially viable initiative, which not only provides employment, it can perhaps provide energy, but also provide value and growth to your own company. And then finally, agriculture and feeding the region. It's a very, very populous region, as I'm sure we don't need reminding. However, the amount of produce that we have to import to the region and the amount of waste of produce actually that goes through the value chains is incredible. Due to the distances and the lack of technology and the lack of the pure logistics and that is actually executed or used across the region, there is a lot that can be done to improve the productivity at farm, to improve the transportation across logistics, but also in the distribution and in the waste that we have in our homes and restaurants, etc. Better initiatives across all three of these, but using agri-tech solutions will enable us to, first of all, save more of the food that we're creating, but also help us to nurture and grow more and retain more of the produce that we have, that we're able to produce within the region and not have to import so much that we do from outside of the region. Now, finally, as we go through all of these, as I've mentioned a number of stakeholders. I've mentioned businesses, so I've mentioned government, I mentioned society at large. The 5 growth principles that I've just highlighted are not new to you. I'm sure they're not. However, what we see is that for Asia Pacific to really succeed, these 3 entities, business, government, society, have to work much, much closer together. I think we've seen better collaboration within value chains now. I think COVID-19 showed us that value chains that were siloed, where tier 1 and tier 2, tier 3 players were not working together, that provided great disruption. So if you take that learning beyond just a commercial value chain and think about how businesses work more hand in glove with government and more with society, providing greater transparency is just an example, that will enable us to succeed in how we execute those 5 growth pillars at the rate that we need to ensure that Asia Pacific does fulfill its potential, but also change and become adaptable and flexible to the disruptions that we will face. Disruptions all around us. It is going to happen. We are going to have. There will be another disruption. Whether you think it's from a health perspective, one might be that's not too far from concept is a cyber attack that takes down our banking systems. I don't think that's too far a jump away, and I'm sure my friends on the call here would be saying that their institutions are looking at this all the time. But that is not a disruption that's too far. So we live in a world of disruption. It's not going away. Therefore, we need to develop strategies that accommodate disruption to enable us to weather that and still grow in a resilient manner. So I'll hand back over to Tiff, and happy to take any questions on that.
Okay, thank you, David. Thank you for the presentation. Now, I think it's also time for companies to think about what are some of the strategies they can go about to, go against disruption in the future. Now, next up, we have with us is Mr. Terence Wu, FX specialist, FX research and strategy at OCBC Bank. He'll be sharing more about the outlook of the US currency, some of the key developments, and how ASEAN FX will play out in the near term. Terence, please.
Good afternoon, everyone. Now, I am just going to present the overall outlook in the US dollar, how we see it over the next quarter to 2 quarters. Now, I think if you recall what happened last year, basically the dollar itself was in a big depreciation trend since the COVID started. So basically it was depreciating for a good 3 quarters before the turnaround sort of started this year, right? And you can argue whether it is just coincidence or is it a signal, right? But that turnaround came when the Democrats actually won the 2 by-elections and end up with a 50-50 Senate, and then with VP Harris as the tiebreaker, right? So in that kind of, in that sense, the whole idea of doing an FX update in the midst of Biden's 100 days becomes very interesting, right? The other thing also is that the going forward, Biden's policy choices is going to have a very important impact on the overall macro performance for the US, and I think that is the reason why the dollar may be strengthening in the forthcoming quarters. Now, I am very conscious that I am speaking about the dollar turning stronger at the end of April. And if you are aware here, the dollar basically has weakened quite significantly over the course of April itself. But yet we are still at a level that is sort of still supportive of the overall upward trajectory of the dollar itself, right? Now, let me, and in that context, right, I will start off with the dollar negatives, right? Since we have been seeing a little bit of a weakening in the dollar. Now, there are some very long-term structural dollar negative arguments, right? You would have seen the chart on the left of your screen about the US twin deficits, right? And US twin deficits have been worsening over the course of the past year or so, right? And going forward with Biden coming in, there will be more fiscal stimulus, virus relief plans. All these are all deemed as negatives if you just focus on twin deficits, right? The other thing, of course, is the share of US dollar as a total share of FX holdings also have dropped below 60% for the first time. So again, there's this idea that the dollar itself is not seeing a lot of demand by the central banks going forward. And a lot of that, although these are very well-worn dollar negative arguments, we think that a lot of the nuances have been glossed over when we have this kind of arguments, right? For example, the fiscal stimulus and virus relief plans, yes, they will add to fiscal deficits, but in the near term, it actually spurs growth. Well, at least it is aimed at spurring growth, and that whole growth outperformance actually is a supportive for the dollar itself, right? And of course, when it comes to the FX, the valuation of the FX holdings, a lot of the valuation issues are not being calculated in. And the whole idea here is that the dollar, partly as a percentage of total holdings, have fell below 60%. It is mostly because of the depreciation that we have seen over the past year, not exactly in the sense that, you know, people are actually demand less dollar in absolute terms. Now, a little bit shorter term really is the whole idea of global recovery. Now, remember right at the start, we did a poll, right? Selena did a poll, and about more than 50% of the participants here are actually optimistic about growth this year, right? Now, so this consensus that global recovery is still very much the global narrative right now, is still the consensus. And the negatives that we have been seeing, whether it is resurgence of pandemic cases, whether it is mutant variants, whether it is complications on the vaccines, all these are effectively being brushed aside, right? And the example that a lot of optimists bring up is how Europe, right, has very effectively weathered a lot of pandemic resurgent cases. They are now probably in the third wave or even the fourth wave, right? So that is still the consensus narrative globally. And how that affects the dollar is that the typical argument that we have is that the dollar tends to weaken amid global growth recoveries. So you're familiar with the idea that the dollar is a safe haven currency at this point, right? So when you have a strong global growth, you tend to have less demand for safe haven currencies. And that is the reason why dollar will weaken. But I think there are some signs that the market has been increasingly fatigued with these narratives, with this particular narrative, and the so-called reflation trades have been struggling. If you look at Asian equities, for example, commodities have been struggling until about the middle of April, right? So perhaps the idea here is that the positives have been very much priced in, and the risk is now on the downside when it comes to this whole global recovery narrative. And in the very near term, there's this sense that there is a creeping kind of risk-on bias that is coming back into the market, right? So the idea here is that if you look at US equities, it continues to print new highs. Cryptocurrencies were printing new records until probably about 1 week ago, right? So the whole idea again is that dollar as a haven currency may see some near-term pain. But what we are looking out for really is that we may actually see another turn in these near-term and structural issues, right? That will lead to outperformance in the US macro side and also the dollar, right? So now, I said just now that there is some sign that the market is a little bit fatigued about this whole global recovery narrative. Why do I say that? If you look at the positioning in the investment community of the Aussie and the CAD, right, you realize that the short Aussie and short CAD positions have been pared down, right? So basically, there is some improvement in terms of overall sentiment compared to 2020, but yet this year we do not see people building up long Aussie and long CAD positions. So the idea here is this: if you are really very confident about the global recovery, what you will do is you will load up on the commodity currencies, right? You will load up on your Aussie, you will load up on the CAD. But yet, this has not happened this year. So there is some sense that there is at least one portion of the investment community that remains quite concerned about this whole global recovery narrative as we speak. Now, so the idea here is what can cause the dollar to sort of turn around from its negative outlook, right? And this is really where the US the strength of the US recovery comes into play, right? Now, the US recovery from the COVID hit is very much in play since the second half of 2020, right? If you look at the four charts on the right of the screen, basically you see that how the data points have evolved, it is very consistent with a swift recovery, right? It's essentially a V-shaped kind of recovery in the US itself, right? But the problem is that the market does not believe in these data. The market does not believe in these data partly because Fed has not changed its rhetoric. Fed has continued to say up till January this year that economic activity and employment has moderated, right? It is only in the March 2021 FOMC that they started to talk about the economic activity turning up. And overnight yesterday, we actually have the April FOMC, and that is when they really started to talk about economic activity having been strengthened, right? So you notice that the communications from the Fed have started to improve, right, in terms of its outlook to the US economy, right? And going forward, because of the Biden's infrastructural program, because of his swift passing of the relief bill, I think all these create the groundwork for the US to have a stronger recovery going forward. And if you compare how the US is doing to the rest of the major economic regions, you will notice that it is very clear that at least on a data release kind of point of view, the US is actually outperforming. The charts that you see on the screen right now essentially shows the macro surprise index, which basically tracks positive data surprises against negative data surprises, right? And what you can see is that US is clearly outperforming in terms of its actual data releases relative to analyst expectations. And if you compare the US against China, the contrast is very clear, right? Now you may think that there might be something wrong here, right? We have always said China is first in, first out when it comes to the pandemic. Why is it that the macro data is so weak in China? If you look at Chinese data very closely, you will notice that basically since Chinese New Year onwards, the data has started to weaken, right? And the fundamental reason for that is even as China is first in, first out of the pandemic, so that is an advantage at the early stages. But it is also first in, first out in terms of policy support measures, right? So as it starts to pull back on its policy support measures, as it starts to pull back on its credit availability, right, then we will start to see China's recovery pace start to slow down, right? And that has a follow-on effect on the rest of Asia in particular. So now what we are seeing essentially is that the US is looking to emerge essentially as a global recovery leader at this point, right? And up to April, basically we have started to see the dollar pull higher, right, in response to this outperformance in the US macro data prints, right? There is still space for dollar to catch up, catch up to the data outperformance. And the interesting thing is April has been basically a month of very strong data for the US, not just from the labor market, but also from things like durable goods orders, so on and so forth. Yet the dollar has not been pulling, right? So again, our view here is that this is still very much a temporary kind of phenomenon, right? Also translated to the US Treasury yield front, right? Despite the strong data coming in, we see the 10-year nominal yields actually sinking lower towards 1.6%, right? From the top of around 1.75% now. So again, our house view for back-end US Treasury yields is that it will still be biased higher. So this trip up in terms of the overall in terms of the US dollar and also the back-end US Treasury yields is just an anomaly in our view, is a bit like a correction in our view. So it does not signal a turn in terms of the overall trajectory. And that belies our fundamental sort of upward bias for the US dollar in the medium term. Now, again, the victory for the Democratic Party in the Senate race, essentially we think is a catalyst for the FX market to start reacting to the higher US Treasury yields. If you look at the chart on the left of your screen right now, essentially the back-end US Treasury yields have been moving in favor of the dollar since the second half of last year. But yet there is no reaction for the dollar, and that reaction only really comes at the turn of this year, right? And again, the Senate win is one catalyst. The other catalyst is the Fed actually turning a little bit in terms of its overall rhetoric, right? So right now, what we see is that there is a sense of the Fed being relatively more hawkish compared to the other central banks. But this is not in terms of when they will start to taper or when they will start to hike their policy rates. But instead, this is based on their relatively hands-off kind of stance towards the rising back-end yields, right? If you notice, when back-end yields started to go higher globally, all right, the ECB started to get very worried. The ECB started to come in and say they would raise our PEPP purchases, raise our asset purchases to pull down back-end bond yields, back-end core European government yields. But that has not come to pass in the US. So I think going forward, this fundamental difference between the stance of the Fed and the ECB basically allows the back-end yield differentials to continue to pull wider in favor of the dollar. And the correlation between the US Treasury yield differentials and the DXY index, which is a broad dollar index, essentially has been very strong in recent weeks and months. Now, so going back to that whole growth consensus that I touched on a little bit at the start, if this growth narrative, this consensus continues to hold up, right, then we may actually start to see the commodity currencies like your Aussie and your Canadian dollar being able to resist dollar strength better, right? And that translates essentially that the euro and the yen will be the main laggards within the G10 space, right? And we have started to see this over the past 1 week or so, when the market is starting to turn a little bit more positive in terms of overall sort of the whole global narrative, global growth narrative again, and you start to see commodity prices being higher again, right? Now, but if this consensus starts to falter again, if we see another significant outbreak in terms of the virus resurgence, then essentially what we are left with is a very singular sort of pro-dollar narrative based on the US macro outperformance, right? So this is the risk, the sort of a bit of a binary risk that we are seeing at this point in time. Now, just in the last couple of minutes, let me just touch on renminbi, right? And basically here, into the second half of last year, we actually see a very strong run higher in terms of the renminbi. And that was driven very much by the faster recovery in China and also the very elevated yield differentials that we see in China at that point in time. Now, both these two drivers have started to fade in the start of 2021, right? And the so-called secular bond inflows due to index inclusion also slowed down because the FTSE Russell essentially had a very extended adjustment period that was essentially longer than what market has expected. So in that sense, the near-term expectation for renminbi upside has actually been very sharply curtailed, right? But the flip side to that story is that we are also not looking for very extended period of renminbi weakness, right? So essentially what we are seeing now is the renminbi is supported on a basket basis and more recently by a little bit of a soggy, a little bit of a weak dollar complex. So essentially going forward into this year, we are actually expecting the renminbi to be very much range bound, at least in the next in the coming weeks and perhaps up to a month or two, very much range bound between 6.4 to 6.6. Now, translated to the Asian currencies, because the renminbi is not expected to be on a strong depreciation bias, that provides a little bit of a shelter for the Asian currencies as well, right? And the other thing that is still supportive of the Asian currencies, is that if you look at the real yields in South Asia, in Asia itself, it is still very much within a band compared to the US, right? So going forward, the risk here is that the nominal US Treasury yields will start to rise very quickly amid a stalling or a peaking inflation expectations kind of environment, and that may translate to higher real yields to the US. And once we see significantly higher real yields in the US, the risk here is that Asian assets may be comparatively less attractive, and that may weigh on the Asian currencies. Right, so at least at this point in time, we are not seeing significant sort of depreciation pressure in most of the Asian currencies. In fact, we have this very neutral view in terms of the broad swathe of Asian currencies at this point. The initial sort of depreciation pressure that we have seen in March has sort of come back to neutral levels. And maybe just end off the very last slide, and this is on the Sing dollar itself. Now, if you look at the Sing Near, which is basically the Sing dollar on a basket basis, it has moved very quickly higher over the past 3 weeks or so after the MAS policy meeting. Right now, standing around 1.3% above the parity level, and we think this elevated level is a little bit unjustified. And we are looking out for the Sing Near to come back down towards 1%, where we are a little bit more comfortable. The reason for that is we are not expecting the macro outlook in Singapore to be so bullish, such that it allows for a tightening move in the MAS in the October meeting, right? And one interesting thing to take note is if you look at the bar chart on the left, that green segment on the bar chart is actually very wide. So that is the attribution of the US dollar to the Sing Near movement. And what you can see essentially is a very large part of the recent increase in terms of the Sing Near is actually attributable to the weak dollar. And if we do see the dollar actually turning around, then we may actually start to see the Sing Near coming back off again. Right, I think this is all the time I have for this presentation. The summary slide is in front, and I'll pass the time back to Tiffany.
Okay, thanks, Terence. Thanks for the wonderful presentation on the Forex risk and, of the outlook of the US market. Now, before we start off with the Q&A, for those of you who would like to receive the presentation deck, please take some time to fill up the feedback form at the end of the session. To request for the slides after you have completed the form, the presentation deck will be sent to you a few days later after the event. So now, without further ado, let us welcome back our three speakers for the Q&A sessions. And as well as together with us, we have Ms. Annisa Natalegawa, Partner and Managing Director of Asia Group Advisors, will be joining us as the moderator of the session for today. Now, if you have any questions for our speakers, feel free to submit them by clicking on the Q&A button at the bottom of the screen and type in your questions. Do note that as we have limited time for the Q&A session, we will not be able to answer all questions. Thus, we seek your kind understanding that should your questions not be answered during this session, please contact OCBC Bank, PwC Singapore, or Asia Group Advisors directly with their contact details featured on the screen, or email SCCCI, and we will forward your enquiries to them too. Now, let me pass off the time to Annisa to start off with the Q&A session. Annisa, please.
Thank you, Tiffany. Thank you to all speakers. I think we've had a very cross-cutting and detailed set of presentations over the past 1.5 hours almost, starting with a very forward-looking as well as an analytical look at the Biden administration, followed by David's presentation that was focused very much on a number of cross-cutting issues that would impact companies in this region. And of course, Terence's very detailed presentation that we just closed off with. So we have a number of questions that have come in already. I think to kick us off, one of the sentiments that I drew out from the presentations, despite kind of everything that's been going on, it has actually been one of remarkable optimism, and one that points to potential for several companies that are operating and focused on Asia and Southeast Asia specifically. So with that in mind, we have one question here that's come in, seeking maybe the advice of the panelists on local companies, and given the current market situation, whether it's now time for local companies to start looking at expanding their business, perhaps within the Southeast Asia or broader Asia, or even going global, or whether it's still a time to wait and see due to continued uncertainty. So I'll turn it over to maybe David first to give his view. I think this aligns quite well with your presentation.
Yeah, I'm not sure if you can hear or see me, but yeah, to your point, I think from local players, it is very much an opportunity now, and preparing to look outside, looking for partners. So when I say partners, it's either partners for outbound expansion. So looking if you're actually looking to expand from a proposition or a services perspective, how you can actually enter a neighboring market. Yeah, I do think it is now. It's now time to evaluate where that market might be and looking for partners on the ground. But from another side is, if you are more in the value chain, it's going back to that point I mentioned before, is here, how can smaller local players here play a role, what is the tier 2 supplier practically role in the supply chain? And that therefore means looking to third-party partners. So for example, banks, right? They have partners all over the region. They have clients all over the region. Banking institution, and we're working with a number of them, who have that visibility as to what certain players are looking for, and therefore within other parts of their portfolio, can they play that role of matchmaker? But it's a trusted matchmaker, because if you're a client of a particular banking institution from a smaller company and you're actually also banking a large corporate, there is an element there of credibility. So I think there are avenues to explore. It's not thinking I have to go out my own, where do I start? I think there are some institutions that probably small medium enterprises currently work with or have supporting them to ask that question. And as I say, I know that we're actually currently in the middle of supporting a particular institution on exactly that topic, because they want to be able to help small medium enterprises connect with large multinationals out of region to be their partners in region. So I do think it's now. I'm just looking for the right people to work with and to help you.
Thank you, David. Selena, would you like to weigh in? I think this also links to your point about some of the opportunity given the supply chain diversification trend that's accelerated over the last year.
Well, I think if we look 1 year back, obviously it was really more about survival on a day-to-day basis, especially in terms of access to funding and cash, mainly because the demand side had collapsed during the global lockdown. I think at this point, really, the global and the domestic economy is at an inflection point. Essentially, we are on the brink of a recovery story, albeit it's still fairly uneven. So depending on which sector you're in, I think we had a fair picture from the MAS macroeconomic review yesterday that there are certain industries that are leading, like manufacturing and electronics, for example, whereas some of the others, like food and beverage, or the retail, and also the airline and the tourism related industries are struggling to recover for a longer period of time. So I think the short answer is yes. I think the reality is that if you are domestic oriented, the Singapore market is still fairly small, and the domestic consumption story is probably not going to make up for the shortfall that we see in terms of external demand. So actually the Singapore government has been trying to help a lot of local companies to regionalize and internationalize. So even in the past few budgets, including the latest one in February this year, a lot of schemes and grants and incentives to basically help local companies, especially the small and medium companies, to spread their wings overseas. The market readiness access scheme, for instance, I think it will be quite an important one to look out for. So I think if you do see that there are some green shoots in recovery in your industry, and you should be planning for the next, despite all the uncertainty that we see now, you should really be planning for the next stage of growth, which is really to capitalize on a post-COVID environment. So I think now it will be a good time.
Thank you. And with regard to, I think this ties into another question that has come in from some participants, and it surely will be top of mind as companies, local companies are also planning their growth plans and potential expansion, which relates to, I'll throw this question to you, Terence, about the exchange rates and kind of how, I think you covered in quite a lot of detail about the renminbi, but maybe your views on other currencies, Singapore dollar included, and particularly with regards to exchange rates for US currencies versus other major currencies and your forecast therein.
Yeah, I think what we have spent a bit of time to establish is that in the coming probably 3 to 6 month kind of time horizon, it does seem that there is scope for the US the US macroeconomic prints to come in stronger than the rest of the major economic regions. And that plays out in the data, right? But the flip side is that we need the market to be convinced that these data will translate to a stronger sort of rate hike expectations at the Fed, right? And I think that is where the Fed has been trying to push back a little bit more than what we have expected, right? But the fact is that this disconnect between the US sort of data prints and the Fed's stance must eventually start to close, right? So eventually, we will start to see the Fed collapse to the US data outperformance, and eventually they will start to be more willing to discuss tapering processes, right? So I think what we are going to see is that there might be scope for dollar strength, whether it is against the Sing dollar or against other major currencies, in up to a 6-month kind of time horizon, right? And beyond that, then we will need to look at some of the more structural drivers, right? And then it's a separate discussion again. We may actually see places like China and the rest of Asia catch up in terms of growth, and that is when we may see the dollar weaken again. But if, up to 6 months, we still are quite positive on the dollar itself.
Great, thank you. We have another question here. I think we're just keeping it a little bit more macro, just to also try to address questions that might be of interest to the broad group, since we have so many participants. But I think, Selena, you started to point to this in your presentation, but trying to maybe hone in on your views as to how the current administration will create more trade and investment opportunities for, again, here looking at through the lens of a Southeast Asian company.
Okay, I think in my presentation, basically, I did say that, in terms of like China, ASEAN economic linkages, it's actually been growing quite rapidly. And a lot of the China +1 strategy to diversify some of the production out from China has actually benefited ASEAN members. So in particular, I think Malaysia, Vietnam, Thailand for specific manufacturing industries have been the key beneficiary over the last couple of years. But I think we have also to be cognizant that there are some idiosyncratic risks even within some of the individual Southeast Asian countries also. So for instance, in Malaysia, we kind of have like a little bit of a political vacuum at the moment. I think there's still a lot of questions about when snap elections are going to be called, and whether the coalition is going to hold. So there is a big question mark, I think, in Malaysia over the political side. So far, it hasn't really spilled over into the business and commercial space yet. But I think that generally that's something that you may want to keep at the back of your mind. And then you see the same political risk uncertainty in Thailand, for instance. And I think if you look a little bit further now, I'm not to sound too bearish. I mean, as an economist, I would point out most of the risks first, right? So if you look a little bit north, of course, there's a little bit of saber rattling that's going on over Taiwan, for instance. So I think there are opportunities, and as we always say, in every crisis there are opportunities as well. You just have to be a little bit careful about where you're dipping your toes into. I think if you look at some of the commodity price uptick, for instance, you'll be quite interested to know that we basically have a fairly conducive outlook for the oil price outlook for the rest of this year. We think both WTI and Brent, for instance, will be supported above the $60 per handle amid the recovering global demand. So if you're actually in the oil refining business, probably you will expect that demand and margins will get a little bit better from here, right? So I think these are kind of like the thoughts that I have in terms of the local company outlook. And then if you look at Indonesia, for instance, with the omnibus law, there's been a lot of improvements that will be made to the labor market regulations, for instance. So in terms of like President Jokowi's attempt to get more foreign direct investments into the country, I think that's net-net. Indonesia is a big market. There will be lots of opportunities for growth as well. Yeah. So maybe I'll stop there. Thank you.
Thank you. I think then to wrap off, I think we did have one more question for Selena with regards to her assessment as to how the Biden administration is working with other allies, particularly as it manages its relationship with China. So it'd be great to hear your views and your assessments on that.
Okay, thanks, Annisa. I think if you look at what has happened over the last 6 to 12 months, it's a little bit worrying because the Biden administration, even before the Biden administration, the Trump administration, in a sense, was also trying to get some of the allies like the European Union, Japan, and to a certain extent, the Quad members to kind of, be a little bit tougher on China, both on trade, on technology, on intellectual property, and a whole host of other stuff. But what has, I think, really taken some of the market limelight in recent months really is the human rights issues, especially in Xinjiang. So if you look in terms of like what the European Union has come out to do, I mean, bearing in mind that they just signed a trade agreement with China in December last year. So we would have thought that, the ties were actually improving. But more recently, you basically see, the EU basically slapping some sanctions on China, and China basically retaliating tit for tat with equivalent, if not more, sanctions on some of the European members as well. So it does suggest that, like the Biden administration, the major allies are adopting a fairly tactical type of strategy in terms of handling China, meaning that when it comes to certain areas like economic ties, trade ties, they are willing to work and cooperate with China. But when it comes to certain other issues like human rights violations, for instance, they are going to be a little bit tougher. And like I mentioned in my presentation, the use of sanctions, company and individual targeted type of policy tools as leverage, I think that's probably going to happen. The other country that maybe I'll also point out in terms of where a lot of the market headlines have come out really is between China and Australia. Australia in the past was seen as a very close economic partner of China because of the commodity demand story. But I think if you look in terms of the recent months, a lot of the deterioration, a bit of that tit for tat kind of verbal and other measures suggests that they may not be all, ganging up with the US, but nevertheless, China probably has its hands full with managing relations with some of his key economic partners as well. But like I said, it's not all bad. RCEP is a clear example that a lot of the members can continue to work together to try and promote freer trade and economic integration. So this is happening all at the same time.
Thank you. That is a great note with which to end. Maybe the Q&A session, just cognizant that we are a few minutes over time. But yes, that is a good reminder that, while there are all of these kind of ongoing trade tensions and trade dynamics, at the same time, in terms of trade agreements, there has been a lot of movement over the last year, both multilateral as well as bilateral trade agreements involving several countries in this part of the world. So that, of course, offers continued opportunity for trade and investment for Southeast Asia and for Asia Pacific. So with that, I'd like to thank the participants, and unfortunately, David did have to jump off quickly, but if there are any further questions for him, his presentation was very detailed, of course, do reach out to us and we will get those answered. And in the meantime, I'll throw it back to Tiffany to wrap up the session. Thank you.
Thank you, Annisa. That's our final question for this session. So thank you once again so much for all the participants, and a big thank you to definitely Annisa, Selena, David, and Terence for their time and valuable sharing today. Now we hope that everyone has benefited a lot from the webinar session. And before we end off, just a gentle reminder to complete the feedback form by clicking on the link that will appear after you leave the session, so as to request for the slides so that we can also tailor better events for you in the future. Now we look forward to seeing everyone again in our future events. So everyone, please stay safe and healthy. Thank you and goodbye.